If mortgage rates ease, do first-time buyers finally win? Short answer, not automatically. The market's rebalancing, sure, more inventory, fewer frenzy bids, but the math still bites. A single percentage point drop could add roughly 500,000 extra sales, powered by buyers who already have cash or equity. Builders are only forecasting about a 1% gain in new home sales, which won't feed that surge. That gap creates the affordability illusion. Payments dip, competition spikes, and your down payment falls behind 2 to 3% price creep. Watch on, and I'll map the 3 moves that matter more than rate watching. Before we continue, hit subscribe so you never miss the latest updates. You hear rates are falling, and your brain goes, finally, lower payment, green light, keys in hand. But here's the catch. That dip comes with a side of creep. Prices inch 2 to 3% while you're still saving. Your down payment loses ground, and the house you loved in January quietly slides out of reach by July. It feels friendlier because the monthly quote is softer. It's not. It's a shell game. The 2026 headline sounds polite. Rebalancing market, easing rates, modest price growth. That reads like breathing room. And yes, you get a touch more time to tour, fewer panic bids, slightly longer days on market. But a polite market can still be expensive. The sticker moves slower, not lower, and that difference is the whole story for first-time buyers. So what actually hits your wallet? When rates drop, the principal and interest piece of your payment shrinks. Good. But prices don't freeze while that happens. They tap upward, which eats part of the savings. Stretch a 30-year term and your interest paid over time still adds up even if the rate is lower. That long tail is quiet, but it's real. You pay less per month, then pay for much longer. The win isn't as big as it sounds, and then there's demand. A rate dip unlocks more buyers instantly, not next quarter. Now, supply does not move the same way. Builders can't snap new homes into existence, and owners still cling to their sub 4% mortgages. You get a wave of unlocked demand colliding with a puddle of new listings. That's where the illusion breeds. Let's bring receipts. One group expects a 14% rebound in home sales as rates ease. Another expects lower payments, but only modest price relief. Inventory is climbing, but it's not a flood. More like a tide that comes in and stops at your ankles. Days on market stretch a bit, which helps you breathe, but the aisle is still crowded. This is the part agents call better and buyers call still tough. It's like a Black Friday sale where the store opens the doors early but only puts out 5 TVs. Security lets in 100 people and they sprint. Prices didn't spike, but they didn't need to. The odds beat you before the sticker does. Let that sink in. Now quantify the squeeze. A small rate dip improves your debt-to-income ratio and nudges your pre-approval higher. Cool. At the same time, that $350,000 starter climbs $7,000 to $10,500 with 2 to 3% growth. Closing costs don't care about your feelings, they stay chunky and stubborn. Insurance, taxes, and fees don't scale down just because your rate did. Your extra room gets eaten by a slightly bigger price, the same closing bill, and the same moving costs. There's also a timing mismatch. Rates move fast because lenders update daily. Construction moves slow because dirt, permits, and labor don't care about your TikTok feed. Builders see financing ease, then plan, then break ground. One chief economist pegs single-family starts and new home sales up about 1% for the year. That's progress, but it's not the cavalry. It's a scooter with a flat tire. So even if your payment quote drops this week, the market response is not symmetric. Demand shows up today. Supply writes back in 6 to 18 months, and even then it's uneven across regions. The South and West tend to add more homes. The Northeast and Midwest stay tight. Entry-level inventory, the actual stuff first-timers want, remains the rarest animal in the zoo. You're probably asking, does any of this make buying cheaper? Here's the thing. Lower rates feel like a discount because the monthly gets friendlier, but the total acquisition cost rarely falls in sync. Modest price growth clips your down payment's buying power. Comps reset a little higher as more sales close, and the upfronts, title, escrow, origination, inspections, refuse to blink. You can win a slightly lower payment and still lose overall affordability. That's the illusion. So what do you do with that? First, stop chasing headlines as if they're coupons. A rate move is one lever, not the whole machine. Second, understand that the rush can erase the savings you thought you had. If 100,000 extra buyers step into your lane and only 10,000 more listings show up, the math doesn't favor patience for the sake of waiting on another 1/8 of a point. Falling rates alone do not equal affordability. They can spark a rush that wipes out the discount and pushes entry-level buyers to the back of the line. You need moves that outplay the crowd, not vibes that follow it. So if rates aren't the hero, who's actually winning when the gate opens? A 1-point rate drop doesn't just lower your payment. It swings the gate wide for people who can sprint. You're not ready for what's next. Nadia Evangelo's math says a 1% dip unlocks about 5.5 million more qualifying households, including around 1.6 million renters. Only a slice will buy right away, but even a small slice of a big number is a lot of elbows at the same open house. That's the part no headline spells out. The line gets longer and the fastest runners start at the front. Now let's talk who those runners are. When rates slide, the first movers tend to be equity rich and all cash. Older, established, already holding housing wealth. They don't need to wait for an appraisal to come in or a gift letter to clear underwriting. They can waive more, close sooner, and they've done this before. Meanwhile, first-time buyers show up with solid intent and a stack of conditions. Appraisal, inspection credits, maybe help with closing. Sellers see a choice between certainty and maybe. Guess which one lands the keys. These cohorts behave differently because their fuel sources are different. Boomers trade down or sideways with decades of equity. Move-up buyers roll equity from their last sale and bring a clean 20% down plus reserves. Investors show up with cash or hard money and a plan to refinance later. First-timers, especially renters popping into the qualified pool, lean on pre-approvals that can wobble if the appraisal misses or the debt-to-income margin shrinks. They also need time. Rate locks, down payment assistance timelines, underwriting conditions, each adds friction. Friction loses in a sprint. The data keeps pointing at the same dynamics. All cash buyers stick around because housing wealth is huge. Mortgage apps tick up when rates ease, but cash is still cash. And baby boomers? They dominate moves because they can. That's not moral judgment, it's math. When you can wire funds and close in 10 days, you look like a dream to a seller who just wants to be done. Let's put it on the kitchen counter. Entry-level listing hits the market. 3 offers by Monday at noon. One is FHA with a small down payment and a request for closing credits. One is 20% down, conventional, flexible on the close. One is all cash, 10-day close, inspection for information only. Who wins when the seller's biggest fear is a deal blowing up 2 days before closing? The contract with the least ways to die. Speed, certainty, and clean terms just beat warm intentions. Now, is every market a blitz? Not quite. Some metros feel more balanced as days on market lengthen and price cuts appear, but even in those nicer spots, first-time buyers are still rate-sensitive and process-heavy. The minute rates tick down, the sub-median price bracket gets mobbed. The starter home and the starter-adjacent condo pull the most interest because that's where the new qualifiers shop. You're not competing with everyone, just everyone shopping the same aisle. The pool grows, competition concentrates. Below the median, it turns sharp. That's the ripple nobody talks about when they cheer more sales. More sales often means more deals clearing a little higher. Those comps then filter into the next appraisal. Your margin tightens and your strategy needs to change from wait for a lower rate to win with better terms. So how do these groups play the clock? Equity-rich buyers can move on a Thursday because their financing is optional. They tour once, call the agent, and send proof of funds by dinner. Investors do the math on rent or resale and don't blink at cosmetic issues that spook first-timers. Meanwhile, a first-time buyer lines up earnest money, shops insurance, and hunts for a seller who will help with closing costs. None of that is wrong. It's just slower. And in a rate dip, slower gets punished. This isn't doom, it's a scouting report. Rate drops bring more people onto the field, but speed and certainty set the rankings. If you're entering with financing, you need to compensate with clarity. Underwriting fully done, short inspection window, maybe a rate buy down funded by credits so the net to the seller still smiles. Sellers read offers like risk profiles. Reduce the risk, you change your odds. Bottom line, rate drops expand the buyer pool. The fastest buyers aren't first timers. They're the ones with equity or cash who can promise a clean, quick close. And when that wave hits the entry tier, the race tightens fast. Okay, so competition spikes. Does supply save us? If builders are back, why aren't prices calming down? Here's the thing. The cost of money eased a bit, so builders get a small breath. Construction loans and materials financing sting less. That help starts, sure, but it's a nudge, not a shove. Think low single-digit movement in single-family starts and new home sales. It's real. It's happening. It's also tiny next to the flood of newly qualified buyers unlocked by lower rates. But here's the catch. A 1% lift in building activity doesn't counter millions of buyers who just got the green light. Zoning and land use rules still sit on the brake. You can't fast-forward entitlements. You can't magic water, sewer, and roads into place. And the neighborhoods where entry-level buyers want to live, those are exactly the places least friendly to density. So yes, builders step up a hair, the gate for demand swings open a mile. There's a weird anomaly that tricks people. In some metro areas, the median new home price sits under resale because builders stack incentives. Rate buy-downs, closing credits, upgrades. Looks like a deal. Feels like a hack. But inventory is thin, often off the main job quarters, and the popular floor plans go first. By the time your pre-approval gets comfy, the homes that fit your payment are either gone or 20 minutes deeper into the commute. Incentives don't build more rooftops, they just redirect the line. On the policy front, you hear big talk about zoning reform, duplex allowances, and streamlined permitting. Great, I'm for it. But rules don't bulldoze themselves. Even if a city votes yes this spring, you've got to write the code, retrain inspectors, date maps, and then wait for the first shovel. That's an implementation lag measured in seasons, not weeks. You'll see headlines in 2025. You'll feel the supply in 2026 and 2027, if the wheels actually turn. Regional split matters. The South and parts of the West tend to permit faster and carry more available land, so they add homes, not at warp speed, but noticeably. The Northeast and Midwest, tighter zoning, older infrastructure, and fewer big tracks ready to go. So relief shows up unevenly. You might see price cuts and longer days on market in one Sunbelt suburb, while a mid-Atlantic starter home still draws 3 clean offers by Monday. Let me give you a clean example. A builder launches a starter townhome community on the edge of a mid-sized city. Base prices look decent. They toss a permanent buy-down and 5-figure closing credits if you use their lender. Net, it beats resale once you factor the credits. Sounds like you cracked the code. Then you learn there are 120 total units. The city has 300,000 people. Sales blow through phase 1 before the model home is fully staged. Anyone who blinked is now waiting for the next release, and the best lots carry a premium that gobbles the incentive. That's the market in miniature. And if you thought that was wild, the next twist is even simpler. Lot pipelines take years to refill. Developers need to acquire land, run soil tests, line up utilities, and survive public hearings that feature neighbors who hate traffic more than they love housing. Even with cheaper financing, that Gantt chart doesn't shrink much. A friendlier rate regime can grease the skids, but it can't manufacture lots overnight. So here's the thing. You can stare at the rising inventory chart and feel like the tide is turning. It is, but only from not enough to slightly less not enough. The overall growth in housing supply isn't on pace with the demand that a rate dip unleashes in 2026. Inventory might climb, sales might tick up, and prices might cool from spicy to mild. But affordability relief stays capped because the constraint is structural. When the aisle stays crowded, the sticker doesn't have to skyrocket to keep you stretched. It can just drift up while you keep reaching. This is why that soft landing narrative feels nice and still hits your wallet. Builders add a little, owners with rock-bottom mortgages stay put unless life forces a move. New rules promise help later, but later doesn't pay your closing costs. The result is a market that looks calmer and still costs about the same, or a touch more, once you add taxes, insurance, and the stubborn fees that never go on sale. So the mini payoff here is simple. Supply growth won't match the demand unlock in 2026, which means affordability relief has a ceiling. Rates can slide, payments can dip, but the inventory math keeps pressure on entry-level payments. If supply is slow and demand is hot, what does that 14% sales jump really do to your budget? A 14% sales rebound sounds healthy, right? More deals closing, more normal. But here's the catch. That kind of volume can drain your wallet without ever looking aggressive. When more homes sell at slightly higher prices, those sales become the new receipts the entire market reads. Your target shifts while you're still reloading your down payment. You feel better, your budget does not. Let's set the stage. The forecast calls for roughly 14% more home sales and modest price growth. No fireworks, no cliff. On paper, that's stability. The twist is in how those extra closings stack. Every fresh sale at a higher number turns into a comparable for the next appraisal. Appraisers don't guess. They pull the last 90 to 180 days. If those comps float up a percent or two, the next listing has permission to list slightly higher, and your lender now has a higher floor to bless. So even if bidding wars chill, a quiet mechanism pushes prices forward. Escalation clauses don't have to trigger for comps to creep. All it takes is enough transactions clearing a hair above last quarter. That becomes the new baseline. Then the next appraiser uses that baseline. It's a staircase, not steep, just relentless. And you're climbing it with a backpack full of closing costs. Here's the math you can't dodge. A 2 to 3% bump on a $350,000 starter is $7,000 to $10,500 in a year. If you're saving for a down payment, that rise dilutes your progress. You grind out another $500 a month, and the target adds $600 to $900 a month in value. You're treading water while the shore drifts away. Let that sink in, and the broader backdrop isn't generous. Even with this balanced market vibe, affordability gains are thin. Middle-income buyers can afford about 21% of listings. That's the aisle you're shopping in, 1/5 of the store. So when sales jump, those limited shelves get restocked at the new price, then cleared, then restocked again. It looks healthy in volume. It feels hostile in price. Let's walk a real-world timeline. You wait 6 months for a rate dip. In that window, prices tick 1 to 2% higher. Property insurance renews at a slightly higher premium. Local millage nudges your projected tax upward. By the time you circle back, the monthly payment looks almost identical to what you fled, maybe 20 bucks better. Competition is calmer, sure, but the comps are fresher and stronger, so that condo you wanted now needs a slightly bigger offer to appraise clean. The net? Marginal change, not the payoff you imagined. Here's what nobody tells you about appraisal dynamics. Appraisers bracket your target with recent nearby sales. If 3 homes closed at $355,000 to $360,000 with tiny concessions, your $350,000 offer might be the outlier. The lender sees risk. You get a low appraisal. Now you either bring cash to cover the gap, rework the terms, or watch the seller pick a buyer who can. That's how more sales raises the floor even without a frenzy. It's the tide under the boat. The paradox gets louder the more you zoom out. Higher transaction volume helps the economy. Agents, inspectors, movers, and retailers all get paid. It boosts sentiment. It looks like health. But you buy a home with cash flow and down payment, not vibes. If incomes don't jump and inventory doesn't surge, that extra volume mostly locks in the new normal. Your payment, helped by rates, meets a price, helped by comps. Stalemate. Now layer in your savings plan. Say you're stacking $1,000 a month. 6 months nets you $6,000 before taxes on interest. In that same period, a 1 to 2% price increase on your $350,000 target adds $3,500 to $7,000. Your progress gets clipped, and closing costs still refuse to budge. Title, escrow, lender fees, same vibe. You arrive with more cash and find the gate moved forward. So here's the thing. A market can be calmer and still chew your budget. More sales mean more proof that the new prices are the market. Appraisals echo it. Sellers cite it. Buyers conform to it. Even if you avoid a 10 offer brawl, the end result can be a higher comp set that narrows your room to negotiate and punishes thin cash to close. Mini payoff. That 14% sales rebound doesn't guarantee you a deal. It can lift comps and tighten entry-level windows, all while the headlines say, stable, good for volume, not automatically good for your buying power. So how much inventory would it take to finally tilt affordability your way? Everyone says we need more inventory. Cool. How much actually moves your payment? Not vibes, a number. If you want price growth to calm down, you need months of supply sitting in that 6 to 7 range on a sustained basis. The country's been hanging around roughly 4 months lately. That's seller leverage territory. Translation: prices can still creep while you shop for boxes and call movers. Let's pin it down. Months of supply is the speedometer. At 6 to 7, sellers lose the upper hand, and price growth usually flattens. Under 4, buyers chase. As of late, the US sits near 4 months on average. That's not a free fall, but it's not balance either. It feels calmer because days on market stretched a bit. It still hurts because the shelf isn't stocked enough to stall prices. You get a softer tone, not softer math. So why doesn't a rising inventory headline help more? Because the bump is small. Roughly a 6% increase year over year, and longer days on market sound promising, but prices still inch up. That tells you everything. If more homes show up and price growth doesn't quit, you're still short. The aisle isn't empty anymore, but there aren't enough units to make sellers sweat. Without sweat, prices don't back down. They glide. Here's the rule of thumb that saves you time. 6 to 7 months of supply for multiple quarters usually tamps price growth. Sub 4 months keeps upward pressure on. That's not a theory. That's decades of market behavior. It's like gravity. You can fight it with incentives and temporary blips, but the floor wins if the shelves stay thin. Zoom in by region because the map matters. The South and parts of the West are closer to balance thanks to more building and faster permitting. You'll see more price cuts, longer marketing times, and a few sellers blinking first. The Northeast and Midwest? Still tight. Older housing stock, slower approvals, and fewer buildable lots keep inventory lean. And the entry tier, the sub-median starter stuff, lags almost everywhere. Builders make more money higher up the price ladder, so the cheapest units remain scarce. Now a quick case study. One metro saw listings climb through spring and summer. Days on market rose. Price growth cooled from hot to lukewarm. Did payments get easier? Only when rates dipped in the same window and local taxes stayed flat. When insurance repriced at renewal, the savings evaporated. Prices didn't reverse, they decelerated. The payment win came from 2 dials turning at once: rate and taxes, not from inventory alone. Let's quantify the effects so you can game plan. Suppose inventory rises 10% off a low base. Historically, that might shave 0.5 to 1.0 percentage points off annual price growth with a lag of 1 to 2 quarters. A 5 to 6% rise usually just lengthens marketing times and boosts concessions, but it rarely flips price trends at the entry tier. Appraisals still lean on fresh comps. If those comps show slight gains, your payment relief gets capped by the purchase price holding firm. Lag is the silent villain here. Listings show up today, price behavior responds after enough closings rewrite the comp set, which takes months. Meanwhile, every new buyer unlocked by a rate dip arrives now. Demand and supply are on different calendars. Demand runs, supply walks. That time mismatch keeps the pressure on even as charts look better. So why don't single-digit inventory gains change affordability much for first-time buyers? Because your pain lives in the upfronts and the comps. Closing costs don't drop because 5 more houses hit your zip code. Insurance and taxes don't discount because days on market went from 27 to 32, and sellers in the starter bracket still see weekend traffic. They might throw in a small credit or accept a slightly lower escalation cap, but they won't cut 10 grand if 3 other buyers are circling with pre-approvals in hand. The truth you can use need to actually bend your payment. You need double-digit sustained growth in active listings that pushes months of supply toward that 6 to 7 zone for 2 to 3 quarters. Not a 1-month pop, not a seasonal head fake. You need consistency. That's when discounts spread beyond the odd stale listing and into the normal listing. That's when concessions get bigger and prices flatten enough that your down payment gains ground faster than the comps do. So here's the thing. If you're waiting for a headline to fix affordability, watch months of supply, not the weekly new listings. When that needle moves toward balance and stays there, your leverage shows up in the monthly payment, not just in nicer conversations with listing agents. Okay, so the trick is supply. Until then, what's the actual play for a first-time buyer? Rate watching is a trap, so what actually shifts the odds in your favor? 3 levers: product, geography, structure. Pull these and you can win while everyone else sprints after a headline they don't understand. Here's the setup. Most buyers run the same play, scroll the same listings in the same zip codes with the same plain vanilla loan. Then they wonder why they get smoked by cleaner offers. The fix isn't waiting on 0.1%. It's changing the kind of house you target, the map you hunt, and the way you write the deal. Move 1. Product. Target builder inventory that comes loaded with rate buydowns and closing credits. Builders move volume. They hate carrying costs. When their lender buys your rate down and throws in 5-figure credits, the net cost can beat resale even if the sticker looks higher. That's the catch most shoppers miss. You're comparing monthly on Zillow screenshots while the builder is quietly paying your points, your title fees, and sometimes your HOA startup. It's like ordering off menu. Same kitchen, better meal. Don't chase the model home alone. Ask for the spec list, the quick move-ins, and the standing inventory with aging days. That's where the deeper buydowns hide. Move 2. Geography. Hunt the balanced pockets where inventory and days on market are rising and price cuts are real. South and west suburbs are showing more balance. Some emerging Midwest metros are too. That's where sellers blink first. You'll see longer marketing times, reduced list-to-sale ratios, and real credits at the table. Meanwhile, tight Northeast and Midwest cores stay sticky. So shift a couple exits down the highway or cross into a neighboring school district with similar scores but less FOMO. The commute might add 10 minutes. The price cut might save your deal. Move 3. Structure. Your terms are a weapon. Use permanent buydowns if you plan to hold. Use a 2-1 buydown plus seller credits if you need relief up front and expect income growth. Lock and shop, so a small rate move doesn't nuke your buying power mid-escrow. And yes, chase assumable loans when eligible. FHA and VA can be pure gold if the existing rate is low, and the seller is realistic about the equity bridge. Stack these with seller credits so the net to the seller stays clean while your monthly drops. Sellers care about the bottom line and the calendar. Shape your structure around both. Here's what the market is whispering that you can use. A chunk of sellers are showing flexibility. Some are pulling listings when they don't get terms they like, which points to a more balanced vibe. Price drops are up. That means more room for concessions in the right pockets. When you see withdrawn listings around 6% and nearly 1 in 5 homes posting a price cut in a given period, you're in a zone where a well-structured offer can land credits without begging. That's leverage, and it's hiding in plain sight. That's it for today. Like the video, subscribe to the channel, and stay tuned for more updates you won't want to miss.